Hello, everyone, and welcome. My name is Roger Weird, and I'm a senior financial consultant with IG Wealth Management. I appreciate you taking the time to view this presentation today. First and foremost, I hope you and your family are staying healthy and managing during this difficult time. Like everyone, I'm concerned for the wellness of my family and the community, so we have moved our office to work from home. So I'm reaching out to you in a new way, from my home to yours. As we are all trying our best to stay well, we follow the advice of the health professionals to eat properly, get enough sleep, exercise, and try to manage our level of stress. So on the topic of managing stress, it starts with acknowledging the actual stress points or emotion, assessing the risks involved, managing the risks we can, and doing whatever it takes to help protect against the risks we cannot control. During volatile times, financial uncertainty can be an added stressor, and I want to try to alleviate some of that stress for you by sharing how we have built your personalized plan to include strategies that address risks to the long-term goals. We can't control what happens in markets over the short term, but if you understand how we manage your plan to meet your long-term objectives, you can face the future with confidence and stay the course. As market volatility increases, investors typically want to move into safer investments, hoping to avoid further losses. The challenge with that is reacting to short-term market noise by making these dramatic portfolio changes can interfere with achieving your long-term goals. History shows that by maintaining discipline and perspective during market downturns, a patient investor is often rewarded when markets return to an upward path, which they always do. So this year, we are experiencing significant volatility as a result of the global health pandemic. This event has created uncertainty, and during uncertain times, the world's stock markets tend to decline in the short term. That's why it's so important to have a diversified investment portfolio. When you diversify globally, as well as by asset class, it creates stability in the portfolio during times like we're experiencing today. Now, it's important to note, what you're seeing on the television and reading in the headlines is not necessarily what you're experiencing in your portfolio. Why? Well, as highlighted on the slide, the broadest Canadian stock market and the US stock market, represented by the S&P TSX Composite Index and the S&P 500, was down over 30% at one point this year. However, many of our managed solutions were only down a fraction of that amount. Proper portfolio construction reduces risk and provides downside protection. For the last 11 years, we've been enjoying one of the longest economic expansions and strongest bull markets in history. But you wouldn't have known it on March 9th, 2009. On that day, the S&P 500 index was down by 50% from its previous high, and many people believed capitalism had failed. Taxpayer dollars were being used to bail out the global financial system, and the forecast for the future was bleak. There was little optimism for the stock market, as it was believed that economies wouldn't grow for many years to come. Since March 9, 2009, we've had one of the greatest bull markets in history. But since that time, investors have lived in constant fear of the next financial crisis, as you can see in the slide. We've endured many events that seemed at the time to be permanent barriers to future financial success. In each one of these instances, and many others, the first reaction of the stock market is to decline. But then markets eventually rebound. In fact, over this ongoing cycle of crisis and recovery, markets have continued to reach new highs. As the graph demonstrates, the S&P TSX has delivered an annualized return of approximately 9% since 1956 and has proven to be resilient throughout the worst market conditions. Over the same period of time, there have been many instances where the S&P TSX declined by more than 10%. As the chart illustrates, this has happened 24 times since 1959, yet each time the market recovered and achieved the higher level. Throughout history, equity markets have experienced periods of volatility, yet despite this, they continue to be resilient. Staying the course is extremely important during periods of volatility, as it enables investors to fully recover from these periods and achieve their long-term investment goals. Now, the question I like asking is, if you could go back in time knowing what you know now, how would you have capitalized on the downturns in the past? Now, most would answer, if I had money, I would have bought more at those times. And you would have been right. But what if you didn't have any more money? That is where our world-class advisors come in. We have some of the best asset managers in the world managing your money, looking for opportunities right now. Many of the strongest market returns occur in the period immediately following a sharp decline when individual investors are feeling the worst about what is happening. Since 1950, following the worst 12-month periods of performance by the S&P TSX, the market made solid gains just 12 months later, with only one exception. And within 5 years, the markets were up significantly, meeting and exceeding long-term return expectations. Now, in order to take advantage of those returns, it's important for investors to continue focusing on a long-term plan, stay the course, and remain invested. Those who panic and exit the markets, even for a short while, risk missing great opportunities when the markets recover. Now let's go through the 5 principles of your living plan. 1. Use time to your advantage. Time is your greatest ally. 2. Diversify your portfolio. Make sure you don't have all your eggs in one asset class or country. 3. Avoid emotional decisions. Most decisions we make off of emotion are usually not the best ones, and we need to follow logic. 4. Maintain a long-term focus. Your financial plan should be designed to last your entire life. And 5. Stay invested. That's how you win, and that's how you succeed. Now let's unpack these one by one. Investing for the long term is one of the best strategies for offsetting the impact of short-term market volatility. Financial markets can quickly move in and out of favor. Staying invested ensures you are always capitalizing on the upside of the market and reducing the impact of short-term market volatility. Although the probability of negative returns in the short term is relatively frequent, the following chart illustrates that, more importantly, the possibility of earning a positive return greatly increases as the investment term lengthens. Said simply, in the short term, markets are very unpredictable. However, in the long term, they are very predictable. They are positive. Now, deciding what to invest in can be a daunting task. Whether you're a new or experienced investor, investing in a diversified multi-asset portfolio removes that guesswork of how to successfully invest over the long term. This chart demonstrates that, in many instances, the top-performing asset category changes every year. As well, asset categories that are among the best one year could be among the worst the next, while others can remain somewhat consistent year over year. By diversifying across different asset classes and investment styles, investors can offset risk and increase portfolio returns by balancing exposures in both positive and negative market environments. Using a thoughtful approach to portfolio construction will properly diversify your assets and reduce the negative effects that any individual security or asset class may have on your portfolio's performance. Now, if you look at this chart, you only experience the roller coaster of emotions if you allow yourself to get distracted by it. There's an old saying, buy low. But note that when that's the case, a typical investor is feeling the worst as shown in the chart. But that is the point of greatest opportunity. That is the paradox when it comes to successful investing. Since 1948, the S&P TSX has experienced 50 positive years, compared to only 22 negative years. In other words, it has provided positive returns roughly 70% of the time. In the chart, annual returns since 1948 are plotted within the respective ranges of returns. The result is a fairly normal distribution, in what is statistically referred to as a bell curve, with most of the returns hugging the 0 to 10% range. In particular, note how the S&P TSX declined by 33% in 2008, and then in contrast the next year in 2009, we saw the pendulum swing completely the other way with a gain of 35%. Generally, negative returns tend to be followed by positive returns, which is why it is so important to stay the course. All investors love the prospect of a rising stock market. However, once the trend starts downward, many investors feel the need to become defensive and retreat to the perceived security of cash or money market instruments. While nobody enjoys turbulent markets, those investors who can focus on the long term and stay invested will stand to gain. For example, an investor who stayed fully invested in the S&P 500 index from January 1st, 1990 to December 31st, 2019, so 30 years, realized a 7.7% annual return excluding dividends. Conversely, an investor who missed the 50 best days of the S&P 500 over that same time period, so only missing 1% of the trading days, realized a negative 0.4% annual compound return. So missing a fraction of the trading days, they would have lost all of their returns. And that is why timing the market is difficult. In fact, it's next to impossible, as you need to be right twice, when to get out and when to get back in. Time in the market is what is essential, and that is why staying invested is so critically important. A combination of discipline and perspective is the key to reaching your long-term investment goals. In contrast, obsessing over daily market fluctuations and short-term noise can be a surefire way to fall short. One way to achieve this fine balance is by having a long-term plan, and then most importantly, sticking to it through all market conditions. While this may sound really simple, recent market conditions have put investors to the test. Veering off course from a carefully thought out plan can turn a temporary loss of confidence into a realized loss on an investment portfolio if you panic and lose your focus. Now, every IG Living plan is developed with a holistic viewpoint and is synchronized across all aspects of your financial life. When you have a holistic financial plan developed specifically for you with expert advice, you know when and how to act, and you can be confident in the decisions that you make. IG Wealth Management is in this with you. We've tested our approach with cutting-edge predictive software, and we've partnered with leading investment managers from around the globe to help deliver results. Together, we can work on creating and maintaining the plan that's most suitable for your unique circumstances. So we take a team approach when building your plan, with you at the center. We can use our team's expertise plus the experts we have in all areas of financial planning to produce an optimal plan. We also believe in coordinating the plan with your other professional advisors, like your lawyers and accountants, to ensure we're all working together on your behalf. This allows us to move quickly, but we do so with complete conviction and confidence. It's important not to be distracted by the headlines, daily news, and constant fluctuations in the world stock markets. Remain focused on your IG Living plan. The plan should be reviewed on a regular basis, especially during times like today, to ensure that you're on track to achieve your specific goals. Your plan will provide the clarity on how to stay the course and capitalize on any attractive opportunities that present themselves. Your regular investment statements serve as a snapshot at a moment in time. For example, you will soon be receiving your investment statements for the end of March, but it will show you the value of your portfolio on that day. And during market downturns, it's natural to feel nervous or unhappy if you see a financial loss on your statement. We definitely understand how you feel, but I also want to remind you that this loss exists on paper only, and it's not realized until a decision to sell is made. So a loss is not a reality until you actually sell. And as your plan has been designed for the long term, our recommendation is to resist acting impulsively and stay invested. When building your IG Living plan, it's important to stress test it. Now, this means using our leading-edge financial planning software to determine the probability of success of your current plan. This advanced technology is available for your plan, and if you'd like to review it further, we'd be happy to discuss it with you. You see, most projections that are created by software will use averages. For example, if you projected a 5% compound average annual rate of return, the software will model your plan as if you were going to achieve a 5% return each and every single year. And we know this isn't reality. Some years will be higher than 5%, and other years will be lower. In other words, you will experience fluctuations in returns from year to year. And these fluctuations, or what we call sequence of returns, truly matter. We run several rigorous trials of how you would achieve the compounded return you have projected to model current events like the one we're going through today. We then determine with probability how successful you will be at achieving your goals. Our focus is to get your plan as close to 100% as possible, which will help you look forward towards the future with clarity and confidence. Over the course of our investment years, there are only a limited number of times when major market corrections will lead to highly attractive investment opportunities, and we believe this is likely one of those times. This could be one of those once-in-a-decade opportunities. As legendary investor Warren Buffett has been known to say, "Be fearful when others are greedy, and greedy when others are fearful." Quite often, when markets appear at their bleakest and everyone is panicking, a focused long-term investor stands to benefit the most. Ladies and gentlemen, we're here to help you navigate and prosper through these turbulent times. On behalf of my team and my family, we wish you great health and safety. Thank you so much for your time today.